Hey guys, what's going on? My name's Avery Lewis and welcome back to the channel, Simply Finance. So guys, before we start, please just hit a huge smash on that like button, and if you haven't already, just consider subscribing. It'll help me out, give me some confidence in the channel. We already had our first video, but I didn't get to go over that much about what this channel is going to be getting into. So this is a finance channel, and I'll be focusing on younger people and more of an introduction to things that you may never thought about that are actually pretty useful to know. From ways to make money to save money, I'll cover the stock market, different jobs, lifestyle, and how to be efficient with your personal finances. Stick around today to learn about the basics of the stock market. First off, this will be very basic. I'm going to stick in a few more advanced concepts to keep those engaged that already have somewhat basic knowledge of the markets. But to start off, I feel it's pretty important to know this concept, that the economy and the stock market have no obligation to share trends. And what a trend is it's the typical up and down movements either in the stock prices or in the GDP of the country. Therefore, when the GDP decreases, it doesn't necessarily mean that the overall stock market will also decrease. This is partly because most people don't understand this, but the stock market is actually forward-looking and based on future expectations of different companies. For example, if the economy is expected to recover, as we are seeing now with the illness, stock futures may be looking good, even though certain businesses are still struggling very much. In simple terms, what I'm trying to say is that the rally that we've had since March, continuing on until today, would just not have happened if it was based solely off the economy's strength. With many impending bankruptcies, we've seen Hertz bankrupt and some other big names that have filed for bankruptcy. Companies have been burning cash and forced to buy their own shares to decrease the amount of available stock, therefore making the stock price look a little bit more appealing. However, in doing so, this makes the company's balance sheet look really bad, and it makes them take on large portions of debt. The balance sheet of a company takes everything from revenue to debt and puts it all into one combined space so that you can see how a company is doing. And this typically determines the fair price of a stock, but it doesn't always correspond with how the stock is doing. And this is typically because the indicated futures of that stock. Basically, the analysts on Wall Street, which if you don't know, it's the mecca of financial markets here in the US and worldwide, honestly. Anyways, those analysts determine price targets based on what they believe the value of one share of a stock is. Investors typically pay a lot of attention to these analyst predictions because it typically drives short-term stock price in the way that the major analysts predict. However, it's not only the analysts that help predict where these stock prices are going. The media is a big influence as well. Some outlets, such as NBC, which is my favorite, actually, if they have a significant following, they usually also have a minor short-term impact on the stock price of certain securities that they provide news about. In just a quick turnaround, I'm going to be explaining why I use the different words stock and company. And yes, this is intentional because there is a difference. Just take the analogy of the square and the rectangle. The square always being considered a square and a rectangle, but a rectangle never being a square. This is similar to companies and stocks because companies are companies and stocks, but stocks aren't always only based on companies. That may have been confusing, but I'll dive into that right now. An ETF, aka exchange traded fund, which I talked about in my first video, is actually a collection of usually top performing companies that have a good record that meet certain qualities. These companies are then taken and put in a collection and sold to investors in the form of ETFs. The major upside to an ETF is that you are diversifying your portfolio at a very low cost. Basically, instead of buying every company within an ETF, you can just buy a share of your favorite ETF, and then you'll receive a fraction of all of your favorite companies at once and have more liquidity for any other investments that you might want to get into. And liquidity, like I mentioned, is the amount of assets, in this case it would be unspent cash, that someone has remaining on the side. Liquidity is good for 4 main reasons. Reason number 1, a great opportunity presents itself and you want to have cash available. Number 2, a margin call requires coverage, and so it can take that money that's sitting on the sidelines and use that, instead of margin calling your account. Number 3, if your holdings fall a lot in value, It'll be unaffected if it's sitting on the side. Number 4, an emergency fund is always good to have. Depending on how much money you make per year, you'll want to decide to have an emergency fund. While this liquidity may be able to sit in a money market settlement fund in your account, it's also a good idea to stash some into a savings account with a larger APY. However, make sure the bank that you choose is safe and follows all regulations. However, because keeping your money safe is more important than the extra, let's say 0.5% return that you would receive in a sketchier bank. I typically prefer larger banks such as Chase, but it is a personal preference and based on willingness of risk. Back on the topic of ETFs and funds such as the money market settlement fund, I just feel the need to say this. No money is actually invested for you until you approve of it and decide yourself. This might seem confusing, but basically what I'm trying to say is that just because you deposit, let's say $1,000 or $10,000 into your money market settlement fund in Vanguard in my case, you don't actually own any stocks yet, and that money's just sitting there, maybe earning a little percentage per year for you. Like I said, depositing money into an investing account doesn't become profitable until you actually perform your own research and actually purchase securities and hold them in your investment account. Making profit typically takes a long time depending on how much money you have in your investment account. For example, let's say you put $1,000 into a stock. Typically, even if the stock performs very well, let's just say you get 10% in the first year, that's $100. That's not that big of a gain. But let's focus our attention on a hedge fund. In a hedge fund with $1 billion under management, they focus exclusively on their picks. This is mainly because a 1% return for them would be $10 million gains, whereas it's only $1 for an investor with $100 invested, or $10 if you have $1,000 invested. Now, in saying this, I'm not trying to discourage you, because I'm not saying that either amount provides any more insight or lessons than the other. I found that starting off with my first $5 and $25 in my account and escalating that was actually way more stressful than dealing with the larger amounts that I'm dealing with today. This was mainly because I just started investing and I really wasn't sure what I was doing. Funny story though, the first stock I bought, I lost 6 cents and I was distraught over it. And then the next day, I never would have thought this would have happened, but I had success in the field and I made 13 cents on my next investment. And ever since then, I've just continued to learn, made money, and invested more, and I've just had a great time doing it. My favorite personal anecdote and lesson that I've learned was actually on a stock called Direct, ticker symbol DRRX. I was consistently making actually pretty great returns on the stock and received news of a possible FDA approval for a drug they developed. While I wasn't going to wake up at 8 a.m. for the FDA approval, I held over $1,000 in my account overnight in hopes that I would just wake up a rich man. However, I never knew just how hard it was to actually be approved for a drug by the FDA. This virtually cost me almost all that I had gained in the past 6 months with that one stock. This is why I just want to continue to stress the importance of doing your own research and due diligence when it comes to taking action with your money, and just learn how to invest in the stock market and learn the risks you're willing to take. I'm sure if I would have researched the potential of the drug or how hard it was to become approved by the FDA, I probably would have gone about the situation way differently and changed my outlook on the stock. But I had no idea the importance of that approval on this whole entire life of the company. I've learned so many lessons similar to this one just over the time I've been involved in the market. With the amount of things that I've learned, I've narrowed it down to a few things that I feel like you should know starting off. First of all, typically stocks don't take large falls on Thursday, which I thought was a very weird fact. Second of all, short-term investors, mainly day traders, for them it's atypical to hold a stock over the weekend due to the uncertainty of a 2-day break on the markets. Day traders typically sell within the week that they buy, if not in the same exact day. Day trading, however, is only one way to approach stocks. This is the main way that new investors have started investing in the stock market, but it's usually only profitable for the few that are really good at it. Most day traders do lose money over time, but they stay in it just because of the fallacies. The fallacy of most day traders is that they tend to focus on the small gains rather than the big losses because people are inherently emotional. Being emotional in the stock market is just about the worst thing that you could do and will most always lead to losses, as I've learned. And I will go over that in part 2 tomorrow, just because the iMovie YouTube limit is 15 minutes. So anyways, I hope you enjoyed, and please like and subscribe. Peace.